Okay, so Dell just swallowed an astonishing $34.1 billion in AI server orders in a single quarter. And now they actually have the Herculean task of finding the parts to build them. You are listening to Earnings Unscripted, where we unpack what really happened in today's earnings. We are looking at Dell, ticker DELL, their fourth quarter results today, February 26, 2026. And Miro, this quarter was massive, but also incredibly messy underneath, right?
Yeah, messy is one word for it. The scale is just kind of violent. I mean, top-line revenue hit a record $33.38 billion. That is, up 23.6% just from last quarter. And operating income expanded to over $3 billion. So you have GAAP EPS at $3.37 and non-GAAP at a record $3.89. It is a massive beat on sheer hardware volume.
Hold on a sec. Quick thing before we unpack all those billions. Just a reminder to everyone that this podcast is not financial advice, just our personal opinions. But Miro, the stock reaction is what fascinates me here, because if you zoom out, the stock basically bled out over the quarter. It trended down almost 30%, hitting like the 110 range in January. And then the bell rings today, earnings drop, and bam! It rockets up 11% in after hours to the 138 level. What exactly triggered that kind of whiplash?
The market finally saw the true scale of the AI isolation. Look, Dell builds the heavy iron, the physical infrastructure, racks, cooling, servers. And for the first time ever, they completely stripped AI-optimized servers out of their traditional server reporting. So we can actually see it on the balance sheet. And that segment alone took in that $34 billion in orders. To put that in perspective, their entire client solutions group, meaning all their consumer PCs and commercial laptops, only generated about $13.5 billion in revenue. AI is just structurally overwhelming the legacy business.
Which is, that is just wild, because the CEO, Jeff Clarke, actually shared this highly relatable story on the call about how they saw this coming. A couple years ago, they gave their own internal developers these basic AI coding assistants, which was fine. But mid-last year, they let the AI agents actually start writing the software based on developer specs. And suddenly, their internal need for compute tokens just skyrocketed. They physically felt the hardware bottleneck themselves.
Right, and that internal bottleneck translates to enterprise panic globally. If you want agentic AI to run, you need dedicated physical architecture. But here is the massive catch. The components required to build those boxes, specifically memory, are experiencing hyperinflation. The spot market for DRAM is up nearly 5.5 times in just the last 6 months. NAND is up 4 times. So Dell is sitting on a historic order book, but they're getting squeezed hard on parts.
Can I jump in on that? Because I noticed that inflation squeeze totally spilled over into their PC business too. They purposefully kept PC prices low to steal market share, which worked for volume, but their client operating income actually slipped, down roughly 16% from last quarter to $629 million. They chose dominance over margins.
Exactly. They absorbed the cost shock so the customer would not have to. It is an incredibly aggressive market share play. You have record infrastructure scaling trying to counterbalance a strategic margin sacrifice in PCs. They are basically running the whole system at redline.
All right, well, that sounds like a massive balancing act. Let us get into the details of that deep dive and see how they're actually managing this $43 billion backlog without breaking their supply chain.
Yeah, they are managing it by basically pulling the fire alarm on their sales processes. What fascinated me in the transcript, the really deep operational shift, is that they brought back the COVID pricing playbook.
Wait, you mean like full supply chain panic mode?
Exactly. I mean, look, when DRAM costs jump 5.5 times, you cannot let your sales guys leave a quote on a client's desk for 30 days. It is financial suicide. Jeff Clarke actually walked through this on the call. He said they realized they were hemorrhaging potential margin, so they squeezed quote validity down to almost nothing. He explicitly said, and I quote, "Our quotes are valid for the shortest period of time they've ever been."
That is brutal, but also kind of necessary, right? Like, if you were a CIO trying to budget, Dell is basically telling you the price is the price right now. But tomorrow, good luck.
Right, and they executed this fast. Clark mentioned they changed the entire pricing of the server business on December the 10th in just a couple of days. Then they had tens of thousands of open quotes in the PC business, and they just invalidated or changed them all on January the 6th. Boom, done.
Wow. Okay, but how does that square with what we talked about earlier? Because they chose to eat the margin hit on the consumer side to gain market share.
Well, that is the beauty of a diversified business. They can bleed a little on PCs because their enterprise infrastructure, the ISG side, is basically printing money. Infrastructure operating margin improved sequentially, and it's largely because of their proprietary stuff, Dell IP storage, as they call it. That segment alone did $4.8 billion this quarter.
Can I jump in here? Because that connects perfectly to what I found really surprising, the cash flow. Like, you hear about hyperinflation and compressing quotes, and you think the balance sheet is going to look distressed.
Oh, it's the opposite. It's practically glowing.
Literally glowing. Operating cash flow spiked massively to $4.67 billion, which is, let me check, up almost 300% from Q3. So they are generating an absurd amount of cash. And what are they doing with it?
Buying their own stock aggressively. They repurchased 14.9 million shares for $2.2 billion in Q4. But then, and this is the ultimate flex, the board approved a 20% dividend bump and a massive $10 billion increase in share repurchase authorization. $10 billion. That is not just, maintaining the status quo. That's management shouting that they are entirely confident in their cash generation going into next year.
Right. They know the backlog is locked. $43 billion in AI server backlog. But, and this is where I start getting slightly nervous, a backlog is just a piece of paper until you get the parts.
Which brings us right back to the supply chain whack-a-mole. You need Nvidia Grace Blackwell chips to fulfill the vast majority of that $43 billion. And Dell explicitly cited that Q4 demand far outstrips current availability.
Precisely. The risk is not demand, it's fulfillment friction. If those components don't show up exactly when projected, that $10 billion buyback confidence starts looking a little, overextended.
It's like they're standing at the absolute center of the AI gold rush, holding the best shovels in the world, but they're waiting on the metal shipments to actually forge them. So, stepping back from all this complexity, where does this leave them heading into the next quarter and the rest of the year?
It leaves them priced for absolute perfection. I mean, their guidance for Q1 is $35.2 billion at the midpoint, and for the full year, they're looking at roughly $140 billion in total revenue, with $50 billion coming purely from AI.
50 billion? That is essentially doubling their AI revenue year over year.
Give or take, yes. But here's the actual friction point. The CFO, David Kennedy, mentioned this guidance incorporates a, quote, prudent view of second-half demand.
Right, which honestly sounds like polite corporate phrasing for, we really have no idea if our customers will still have budget by August.
Exactly. Because of that price shock we just talked about, there is a very real pull-forward risk. CIOs might be draining their annual IT budgets right now just to lock in hardware before memory gets even more expensive. So by the back half of the year, demand could suddenly evaporate.
Hold on, let me jump in here. What about the actual tech cycle? Because Nvidia is going to introduce their next generation Vera Rubin chips later this year. Does that freeze up new orders?
Yes, the classic Osborne effect. And Jeff Clark was surprisingly transparent about it on the call. He actually said there is no Vera Rubin in the backlog. There is Vera Rubin in the 5-quarter pipeline.
Okay, so wait. That means the entire $43 billion they're sitting on today is just current-gen Grace Blackwell architecture, which implies their ironclad visibility basically drops off a cliff in about 9 to 12 months.
Precisely. Up until then, it's a brilliant execution story. I mean, you have to give them credit. They are running a global supply chain masterclass right now. But yeah, gravity and hardware transitions always catch up eventually.
Gravity and silicon delays, two things you definitely cannot negotiate with. It's going to be genuinely wild watching them try to build out $50 billion worth of infrastructure this year. Anyway, that's going to wrap our deep dive on Dell for today.
Whether they pull off that supply chain miracle or not, it is always a blast exploring this stuff with you. If you want these market puzzles to just show up in your feed, simply hit follow. Also, just a quick transparent note that this show is entirely generated by AI, which is why our voices are completely synthetic. Drop your ticker requests or thoughts to earningsunscripted@datamadness.ca or find the X link in our show notes. Thanks for listening, and we will catch you next time.
Take care, everyone.